All right. Good Thursday afternoon, traders and investors, and welcome to this week's episode of State of the Market from Finom Group. I am your host, Seth Golden. And as the chart suggests, sometimes the market is easy and sometimes the market is hard. It's a lot like life. Life can be easy sometimes and can be quite difficult at other times, but you kind of have to learn how to enjoy the ride. Or the journey, as some people might call it, investing, um, managing capital in the markets. It is a journey, and you got to be dedicated to it. So, I thought this was a good chart here to start off this week's SOTM. Something else is, I'm a youth minister. For those of you who may not know that already, and I often find that much of what I've learned and preached can help us as investors and traders. One of the lessons we're doing right now with our youth is teaching about the purpose of their life, and I think it kind of applies or can apply to our investing and trading. Does our purpose match our plans? If not, well, therein lay the work that may need to be done. Does the amount of research that I perform fit with my goals and my purpose for investing? Does my overall process match the purpose as well? In thinking about this, kind of harken back to last week's State of the Market, where we confronted David Hunter and his recent big bear market crash call. Recall that this was something we highlighted last week in our State of the Market. In digging a little bit deeper, though, again, this is not the first of such market crash calls that David Hunter has proposed over the years. This tweet was from back in 2016, and I'm sure you can find various articles and videos in which David was outlining his big market crash back then. As this tweet insinuates, yes, and I am still saying it. S&P 500 to fall to 500 and global deflationary bust in 2017. 2-year top is now complete. And recall, this was October 16. What happened, after the presidential election? The market just absolutely ripped through the end of the year. And through all of 2017. And recall, this was one of the longest periods in history that we had, not just without a 5% correction, but without a full-on, like a 3% correction was the best we got into February of 2018. But, when you see these calls time and time again from people like this, and hearkening back to, do our plans match our purpose? In my opinion, you ask at this point, what the heck is the purpose of this, David? Like, why do you keep doing this? At what point does this kind of promotional bias, as it pertains to your market outlook, at what point is it, I'm not doing this for the people, I'm doing it to the people, right? If it constantly fails, you're not doing this for people. You're doing it to people. Because there are a lot of people that listen to this guy, regardless of how ineffective he's been with these crash calls in the past. What's the purpose? Does it match the plan? Another reason I bring back David into our conversation this week as it pertains to the markets going forward, and your plans and your purpose for investing is related to another market crash call, or big losses for the equity market to come, this time by Jeremy Grantham. As he's the latest to warn investors in basically a similar manner to that of David Hunter. In this article here, just earlier this week, big losses ahead for markets. Jeremy Grantham's terrifying new forecast. And he gives his reasons: the 7-year asset class real return forecast based on history. And so if we kind of compile all these folks together, we had a market crash call from Michael Burry, David Hunter, Gary Shilling late last year, remember in July of last year, Gary Shilling, 40% market correction, which is pretty much his annual market crash call, right? He does that every year. But, now lumping in Jeremy Grantham. And the reality here also is, while this is his latest call, for most of these people, it's just their ongoing call. It's not really analysis. And they'll give you a chart and they'll give you the rationale as to why. But the reality is this was his same call from January 11th of this year. Jeremy Grantham, earlier this year. And here's his calls previously, 2010, have cash, wait for stocks to fall. Grantham sees most global equities as ranging from unattractive to very unattractive, valuing the S&P 500 at no more than 950 in 2011. Jeremy Grantham warns in 2013 will be a dangerous year for stocks. What happened in 2012? Double-digit returns. Much of everything else is once again brutally overpriced. Well, of course, if you thought it was going to crash in 2013 and here you are in 2013, it must be overpriced based on your failed prediction in the past. What happened in 2013? Double-digit returns again. Here we are, 2014, big stock bubble. Will end badly in 2016. What happened in 2014? Double-digit returns. 3 years in a row where we had double-digit returns. 2015, the GMO founder, Grantham, says markets ripe for a major decline in 2016. We had a decent pullback in late 2015 into early 2016 of about 15%. Of course, in 2016, we finished higher on the year, just kept going into 2017 and through 2017 and early 2018. These folks, their calls. I have this chart here. Some of you might be familiar with. And Jeremy Grantham is right here. This is the accuracy of this particular study. And this is the benchmark in red. Here's Jeremy Grantham. The benchmark is higher than the accuracy of his calls for this study's time period. He underperforms, and if we kind of go over and you can see, he's about 40-something%, 45% of the time he's accurate in his, broad market asset class calls. What does that essentially mean? It means he's no better than a coin flip. It's 50-50. It's heads or tails. Market's going to go up or it's going to go down. 50-50. Do you need his call for that? And that's the reality of most of these people. Most of them, they're no better than 50-50. More often than not, they have a worse than coin flip track record. What's the purpose of these calls? More often than not, it's look at me, look at me, look at me. And I'm waiting for a bigger correction. A lot of these folks, they want a correction because they want cheaper prices to, get back into the market or leverage exposure higher. It's not really analysis. It's eventualysis, as I like to say. And what are the excuses for these failed predictions? Here's 5 possible excuses. If only this one thing would have gone my way, I would have been right. Something completely unexpected happened, so it's not my fault that my prediction didn't work. It didn't happen, but I was close. I'm not wrong, I'm just early. That's the whole point of eventualysis if you are a perma-bear, which most of these people are. It's just one prediction that failed. Yeah, not quite, buddy. Not quite. But that's the list of excuses. And more often than not, why are these predictions proven faulty? Because the knowables and unknowables are just too wide-ranging. There's no real purpose to make these kinds of calls unless you really just are looking for attention. So, and they tend to happen. These kind of market predictions, bearish, they cluster. They tend to cluster when you haven't had a more significant correction and when we've been trending higher for long periods of time. We haven't had a 5% correction. This chart from Goldman Sachs. It's more than 179 trading days now. I think this is day 184 or 185 without a 5% correction. As this chart shows here, it's, getting up there. There's been others, just as big or slightly bigger. And of course, the granddaddies of them all are nearly double. They're nearly double of what the streak that we're running today. They're nearly double the period of time without a 5% correction. So while this seems uncomfortable for many to not have undertaken a more protracted and deeper drawdown, there's been periods, far and above the current streak. And everybody likes to blame the Fed in this environment too. Oh, we can't get a correction because the Fed is just printing money, right? But most of these took place before 2000, before QE, before zero bound interest rates. Most of these big ones took place before the QE era, or the Fed printing machine, if you will. Only one of them, this one here at 404, has taken place during the QE era. So can't really blame the Fed in this case either. On the one hand, it's been a long time since the last 5% drop, but on the other hand, some of these streaks have been twice as long. Don't try to time a market dip. I guess that's the main point. And historically, though, when we get the market dip, you better buy it. These dips get bought that much quicker. This Bank of America chart here basically points that out. The average recovery time following a 2 sigma one-day S&P 500 decline has shortened significantly since the great financial crisis, reaching an all-time low this year in 2021. And of course, they say as central banks largest continues to incentivize investors to basically seek out alpha or huddle into risk assets. Here it is down here in 2021. The recovery periods are shorter and shorter and shorter. By the dip trend, declining, while the market recovery reaching a new all-time high in 2021. In simpler terms, it's taking investors fewer days to buy the dip after those 2 sigma moves. I'd argue 2 or 3 sigma moves. Investors are piling in, and that's also what this chart here shows. We've actually, people make they draw this conclusion that the markets don't correct and the markets just can't go down. The reality is we've had more 2 to 3 sigma events this year. We've had 10. Then, more than in any time period. You'd have to go back here in 2014 where we've had 10 2 to 3 sigma events. So we've had quite a number of 2 to 3 sigma down days here in the market. But again, the recovery time, you could say the markets have been more volatile. Realized volatility, which is the measure of S&P 500 volatility intraday. It's not the same as implied volatility. The implied volatility just hasn't stuck around because people keep buying the dip that much quicker. Looking at market breadth, as we often do here in the state of the market, on this chart here from Thrasher Analytics and Andrew Thrasher speaks to the fact that, like we know, and we've covered this many a time, market breadth, whether it's in our state of the market or our weekly research report. But this particular chart here shows that more than 20 days of less than 60% of stocks above their 50-day moving average, while the S&P 500 is at all-time highs. So if you look at the bottom, this is the S&P 500 at the top, the percent above their 50-day moving average in the middle, percent of stocks above their 50-day moving average, and the number of days, the percent of stocks above their 50% has been below 60% of stocks. We're now at 27 days, 28 days, including, it's 29 including today. 29 days now where fewer than 60% of stocks are above their 50-day moving average. And in the chart above of the S&P 500, well, most of the times we've seen this particular breadth configuration or characteristic happened in basically 98 to 2000. And anytime you bring those calendar dates, into a breadth study or market study of sorts, people automatically get nervous. It also happened here in looks like 2015, and we certainly did have a market dip thereafter. And it's happening here now again today. I would make the argument that this is still a small sample size, and there are different dynamics at play, and we'll get into that in a little bit here. One of the breadth studies that we've also looked at more recently, including in this weekend's weekly research report, was the percent of stocks trading above the NYSE 200-day relative to the percent of stocks trading above their 50-day moving average in the NYSE. So it's a relative breadth ratio performance chart here. And usually when we get above 2%, as we are here recently, we had been, this is 5 years, going back 5 years. Usually when we see these elevated levels, we quickly normalized here in 2018, had a rally, if you don't recall. Of course, this was the rally throughout all of 2017. And then we had that hiccup, in early 2018, but that got righted pretty quick. And the equity market rallied from April of 2018 and made new highs in September of 2018. And then we had another big hiccup in the market. In the fourth quarter, we had a technical bear market, but then, we quickly normalized. So in each of the previous examples where we've gotten this breadth performance ratio above 2, it's ultimately led to pretty significant rallies in the market, except for this time here in 2020, obviously produced by COVID. So here again, just last week, we got above 2. We've since come back down to 1.83. Will this, lead to another significant rally in the market? This is an exogenous event. This was out of our control. What are the odds that we're going to have another exogenous event, in such a short time period? Or is this going to mirror what we had back here in the other 3 examples? I'd be of the opinion it's probably going to be some magnitude of order along these lines more so than this one. We're seeing the snippets, we're seeing the onset of it today, I think, or even yesterday. Market breadth was very strong yesterday. Market breadth is very strong again here today. So far, it's living up to these billings, as I would assume it would. So when we look at this particular relative ratio performance in the NYSE, the long-term breadth, has been very strong. The intermediate, when you see it, spike up like that, it's because the intermediate breadth is weakening, but the long-term breadth is still very strong. When we see it come down, it's because the intermediate breadth is strengthening. The long-term breadth is not as relevant. And it takes some pretty good intermediate strength, to offset this long-term breadth strength. That's why I say I think we're seeing it today, or the last 2 trading days. Today we've made new all-time highs in the S&P 500. And again, second day in a row, if we look at the NYSE breadth, second day in a row, we're about 3-to-1 advancers versus decliners. And that's why I say pretty strong breadth. If we look at advancing volume versus declining volume, pretty strong today too, in favor of advancing. All right, another way we look at breadth, of course, is you can use the equal weight S&P 500, which is ticker symbol RSP, relative to the cap weighted S&P 500, the SPDR ETF, SPY. We've been in this downtrend here for since looks like mid-May. We've been in this downtrend. Equal weight S&P, broader basket of stocks are underperforming the cap weighted S&P 500, which is generally led by like the top 10, top 20 stocks, your fan mag names, your big cap tech names, so on and so forth. So we've had weaker breadth, we've had weaker equal weighted performance, but we seem to have found, a good stopping point. And one of the things that I'll point out here is this is an upward sloping trend line. We have not made lower lows, which is a good sign. I mean, this is where we were coming into the year, 2021. Coming into the year, we have not made a lower low. It seems like we've made a stand. If we're looking for better breadth, this is one of the places, along with this relative performance ratio that might lead us to believe, we might be expecting, we should anticipate, I should say, better breadth going forward. Of course, this can quickly be abrupted, with some kind of exogenous headline of sorts, but all signs are pointing to some relative outperformance here near term in the equal weight versus cap weighted S&P 500 ratio. Now, a lot of, the market action this year has been somewhat dependent. A lot of the breadth has been somewhat dependent on what are yields doing? What's the 10-year yield doing? And when we've seen the 10-year yield moving up, we've seen that reflation trade do very well. As you can see, it's been moving up here for most of the year, and it kind of peaked out there in March and has been in this downtrend ever since. But even this downtrend in the 10-year yield, ticker symbol TNX, seems to have found its stopping point. Just a couple weeks ago, the 10-year yield was what, 1.18, 1.17, got back up to 1.3, and it's in between there right now. So when we've seen, the 10-year yield moving up, we've seen, somewhat weakness here. Topping pattern there in the technology ETF here at the bottom. But when we've seen the weakness in the 10-year yield, it's undeniable the outperformance here in the technology sector ETF. And in the middle chart, we have the KRE. And this chart comes from Arthur Hill of Trend Trader, Trend Investor. And again, yields going down. The KRE, which is the bank ETF, the regional bank ETF, yields go down, the yield curve flattening, and the banks tend to underperform. Yields go down, technology has been outperforming. So again, if yields are going to start moving up, we would anticipate banks are probably going to start outperforming once again. That reflation trade may come back. The cyclicals may come back. Energy, retail, consumer discretionary, materials, etc., industrials. That reflation trade has largely also been tied to the trend in yields. Now, people might get excited. Well, if the yields are going higher, should we bail on technology? And I would say no. If you had bailed on technology before, well, you lost out on a significant rally in the NASDAQ, in growth, in the fan mag names to basically new all-time highs. They may underperform, but that doesn't mean they won't go up, during once again, a revisiting of new, leadership from the reflation trade. So do keep that in mind. I would expect some underperformance. But I don't think it'll be on the same magnitude as it was in the past. Why do I say that? Well, get the earnings that were just produced. And in discussing breadth in general, one of our focuses from the past was rationalizing breadth weakness. And that's why I have the 50-day moving average of the S&P 500 in this chart here. One of the things we have discussed recently, maybe a month ago, was is this how do we contextualize the breadth weakness that we've seen, over the last month and a half? The question that I encouraged investors to examine was the slope of the 50-day moving average for all cap levels, whether it's large, mid, or small cap. Because remember, we had an everything rally coming into this year. And the everything rally seems to have peaked out in February before we had, more discerning asset allocation to the reflation trade, out of technology, out of growth, out of FanMag. But up to that point, it was the everything trade. And so in looking at the slope of the 50-day moving average, I asked the question, was it really breadth weakness or abnormally and previously strong breadth that led to current breadth readings that proved to be suboptimal? When you get a really big parabolic move in the 50-day moving average, the only real way to get that is if you have an everything rally. Just everything's moving up. And you're getting like 90+% of stocks trading above their 50-day moving average. And that is exactly what happened. It happened in May of last year. That was the first time it happened. We had 90% of stocks trading above their 50-day moving average, and it produced this breadth thrust that carried us through the end of 2020. But in 2021, we still had significant market breadth up till April. In April, percent of stocks trading above their 50-day moving average, once again, 11 months apart, not even a full year, once again, 90+% of stocks traded above their 50-day moving average on April 14th. In less than a year. Previously, if you want the gaps between the percentage of stocks trading above their 50-day moving average was like 3 years. You had a 3-year gap in time between the first occurrence where the percent of stocks trading above their 50-day moving average reached 90%, and then the next occurrence. It took 3 years. This time it took 11 months. So again, that's why we have such a steep slope in the 50-day moving average. So again, it became this question of, was breadth really weak? Or was it really time catching up with price more so than a price catching down with time? Moving averages are time-based. Stock market is price-based. So when the 50-day moving average moves up this quickly, it makes it really easy. If then you go through this period of price consolidation and just moving sideways, then eventually you get a dip in the market. Well, of course, most stocks are going to fall below their 50-day moving average. Another way to know that this was more about time catching up with price rather than price catching down with time is the fact that we get oversold so quickly. I mean, within 2 to 3% of a down move in the S&P 500, you look at most breadth readings and they're washed out. You look at NYSE breadth and it's washed out. Keep in mind, to get above 2% on this breadth ratio, that's washed out levels. And then the market gets bought, the market gets bought, the market gets bought, the market gets bought, the market gets bought. It happens so quickly because the slope of the 50-day moving average and because we've had this everything rally. But again, just to reiterate, if you want to know if this is true breadth weakness and the market is about to really break down, if you want to discern if this was, a price-based correction or a time-based breadth weakness, look at how quickly we find oversold conditions. It can only happen if it's time catching up with price. And again, we live in an algorithmic market. Like the algorithms are going to trigger when oversold conditions are met. Most trading is not active, electronic trading. It's algorithmic. Some 80% of volume is algorithmically traded. They're coded for price levels and oversold or overbought conditions. They execute absent human emotion and what have you, discernment. So a couple of really unique ways. Just looking at the slope of that 50-day moving average tells you. So there's more about time catching up with price than price catching down with time for real weak breath. And you can only get this. You can only get this way if you've had that kind of abnormally strong breath. 90% of stocks trading above their 50-day moving average. Not once over the last year, but twice in an 11-month period. And normally you don't see that, but for 3 years. You don't have that kind of breath, but 3 years apart. All right, moving on. Do we need good breath? Well, the S&P 500, the NASDAQ, they're cap-weighted indexes. You don't need it, but it's nice to have. One of the biggest, cries on social media last year was that too much of the strength of the market was being owed to just 5 stocks. 35% of the market cap weighting was just in Facebook, Amazon, Apple, Microsoft, and Google. And indeed, they let us out of the bear market. They were carrying most of the market. The rest of the market, 495 companies, were still down 5%. Here we are today. Like everybody clamored about this. This can't be sustained, and therefore you should be on alert for possibly the retest of the former lows back in March. But the market has a really unique way of just working these issues out for itself. FanMag has gone through a goodly period of price consolidation for the sake of time, while other stocks have caught up. We saw equal weight outperforming basically since July of last year. Everything was still going up, but equal weighted stocks were outperforming these 5, cap weighted, heavily weighted in the index stocks. And now we're just, the FAMG stocks are just 25% of the S&P 500. It corrected 10% of the market cap weighting since last year. The other thing about, these crash calls, if you will, or just in general, bigger correction calls, again, think about what these companies just reported. If the market goes down 2 to 3%, do you have the discipline not to go and buy Apple down 2 to 3%? Do you have the discipline not to go buy Facebook or Microsoft or one of these big names? Not buy them at a discount based on what they just reported. It's really difficult to make a bearish case on the market without making a bearish case on the 25% market cap weighting in these names, considering what they just reporting. And here's a chart of their cap weightings in the S&P 500. Apple is 11.5% of the S&P 500. 10% in Microsoft. Amazon, which is going to report after the close here today, is 8%. 4% Apple, Alphabet, Facebook, Tesla, NVIDIA, PayPal. I guess my question is, what was wrong with any of these companies' reports? It's hard to make a bearish case on the overall market, which is cap weighted, given the results that these companies just produced. It's really difficult. And thinking bigger than just, the fan mag names and the companies that have reported already. 324 companies reported already as of yesterday morning. 84 to 85% have beaten EPS estimates. 80% have beaten sales estimates. 18% of companies raised guidance. Only 2% of companies have lowered guidance. Having said that, the average one-day share price change in reaction to these delivered earnings has so far been very muted. It's down 0.04% on their one-day share price change in reaction to earnings, which basically tells you a lot of the good results have already been priced into the market. The market stocks are a forward discounting mechanism. It doesn't mean that they won't go higher after a bout of price consolidation, but we've seen this before. We've seen this movie before. Apple is, another example of just that very thing. Apple reported just the other day. Stock went down. Stock has gone down, the last 3 earnings reports. That's highlighted here. Earnings reaction days from bespoke investment, down, 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 and just yesterday, down. But do you really want to sell Apple here after what they just reported? Quite literally one of their best, quarters in history. If anything, your consideration, in my opinion, should be, where do I buy such a dip? How do I buy that dip is more important, really. Based on what they just reported, who cares, where you buy it? How you buy it is more relevant. How much, and how are you going to tactically layer in should price weaken further? This table above here from Charles Schwab, you can see a sector breakdown for growth this quarter and into the next full year. Here's Q2. Right now, 78.4% earnings growth. Q3 is supposed to come down from that growth rate and further and out into 2022, which is natural. We're setting a very high bar off of a very low base the previous year. Funny how the media recognizes the base effects from earnings for their positive impact on the market, but they also negatively hyperbolize the base effects from consumer prices on the economy. It's funny how they manage the narrative. Cyclical areas of the market sit atop the earnings leaderboard, and it includes industrials, consumer discretionary, energy. Much of the reason why they're at the top of the leaderboard is due to their connections to the economy. Technology doesn't have as tight a connection to the economy as consumer discretionary, energy, financials do. The second quarter is expected to represent the peak. It's supposed to be the peak in the earnings growth rate. As of now, the growth rate is expected to slow to about 27% in the third quarter. And this chart right here, also from Charles Schwab, the strength in earnings has continued to decrease some valuation pressure. So, we think of price to earnings valuations, right? S&P 500 forward PE, price versus earnings. Earnings being the denominator, but earnings are growing so strong. And although we continue to make new highs in the S&P 500, the overall market, the S&P 500 valuation is coming down because we're only making small new highs, but the earnings growth is faster, more robust. So the PE is actually coming down. Last week, the PE, 2 weeks ago, the PE was 21.8. Coming into this week, it's 21.3. We've only made a new high of about 5-6 points. So the PE, unless we go up to 4,500, is going to once again contract. This year, earnings have been on fire, which has helped bring down that forward PE. And that's basically what's shown in the chart above there. The PE is now 21.3. At the beginning of this year, it started at 23. Right there, 23. And now we're basically right down here. The dotted lines, so these dotted lines here, the dotted lines show both the expected trajectory for earnings, right? That's going up. The yellow line there, trajectory for earnings, and in turn what the trajectory for the forward PE. The forward PE is expected to continue to contract below 20, eventually below 19, so on and so forth. That's the strength in earnings the market is expecting to see. And we're still at these valuation levels that concern investors. It gets hyperbolized by certain fund managers, or hedge funds, and market, what do they call market personalities, I guess you could say. John Hussman being one of them. Crescat Capital is one of the most notorious bear market funds. And this is their chart of S&P 500 valuations. You can see basically the red here indicates that we are just completely overvalued across any of these metrics that you want to choose from. There's a lot of red in that Crescat Capital issued table of market valuations, which is depicted initially by John Hussman. This is what perma-bear fund managers do. They prescribe a reason to be bearish on markets with variables that literally have no direct correlation with 1 year forward market returns. And for most people, the red is scary, and bears use this table of valuations even when it has proven ineffective measure of S&P 500 forecasting and realized returns in the past. How do I know that? Well, here's John Hussman again. Here's a Market Watch article from back in July of 2014. The bubble makes valuations for most stocks actually worse than in 2000. Again, John Hussman here. This was issued just last week. And John Hussman in 2014. So the same valuation arguments are being used today that were used back then. By the way, what happened to the market from this date going forward 1 year? Let's see. I know I have it here. S&P 500 was up 9% plus from July 2014 through July 2015. Now, it did fall about 15% in 2015. After that point, in August, it started to decline. It declined 15% into 2016, but then rallied through the remainder of 2016. Would you have wanted to sell here in 2014 and miss out on 9% gains? Not knowing that, of course, we'd fall 15% thereafter and quickly recover no more than 5 months later. I guess that's a question you have to answer for yourself. I wouldn't have been a seller. There are various points along the way that you can take profits, rotate into different areas of the market. The preferential way to manage downside risk really is to have a plan, an entry and an exit plan that includes rebalancing, taking your profits from this trade and investment, having a plan for another trade and investment, knowing your seasonal tendencies as well. Valuations in general, you got to keep this in mind also when people promote the idea that valuations are stretched in extreme levels. Valuations really don't do anything but travel higher over time or expand over time. And that's what this chart basically shows you here. This is the Shiller PE ratio. And if we look at the most recent time period, you have this descending trend line, and we just popped above it this year. Right? We just popped above it. But if you had started here in 2008, look at what has happened to the PE level. since 2008. We've done nothing but travel higher over time. Valuations in general are just a very bad, variable to consider when it comes to making decisions on capital allocation. The reality is we don't know when PEs will start expanding. We don't know when they're going to stop in real time and start contracting. So why do we even talk about valuation? We can't understand them but with hindsight. That's it. Can't understand them really but what they've already delivered. This chart right here also tells us if you're thinking out a year, S&P 500 forward PE, the correlation to forward 1 year returns, S&P 500 price performance 1 year later, has a correlation of negative 0.18. There is no correlation between the forward PE multiple and 1 year S&P 500 returns. There is no correlation. So again, we don't know when PEs are going to start expanding. We don't know how long they will continue expanding. We don't know when they're going to stop expanding. Same people that have been telling us multiples are rich. We're in a bubble market valuation. These are the same people that have been telling us for a decade, if not longer. Valuation shouldn't be your main consideration. Don't get me wrong. You want to get the best price possible. But really it comes down to just having a well-rounded plan for executing on dips, because as we saw earlier, those dips don't last very long. And the time that you have to buy that dip gets shorter and shorter and shorter. With that, I'm Seth Golden. This is our weekly State of the Market. Have a great trading day, everybody.